As we enter 2026, the narrative around Microsoft has shifted from building to deploying. The stock has seen some early January volatility, down roughly 2% amidst a broader tech sector wobble, but the long-term thesis remains aggressive. The dominant headline is the AI inflection point. For the last 2 years, investors watched Microsoft spend billions on data centers and NVIDIA chips. Now, in 2026, the market demands to see the receipt. Analysts at Wedbush and other major firms have declared 2026 the year of AI utility. The focus is no longer just on having the technology, but on democratized agentic AI, specialized, smaller AI agents that perform specific tasks rather than just general chat. Crucially, the market is watching for an ROI reality check. Chief Information Officers, CIOs, are now auditing their Copilot subscriptions, asking if they are truly getting $30 of value per employee per month. Early reports from 2026 suggest a secondary wave of adoption is beginning, moving beyond early adopters to mid-market firms, but this comes with higher scrutiny. Microsoft is also actively managing key person risk regarding its reliance on OpenAI, hedging its bets by developing its own internal, Maya, silicon chips to reduce dependency on NVIDIA and external partners. Microsoft continues to command a quality premium over its peers in the Magnificent Seven. Here is a deeper look at the numbers. Price-to-earnings (P/E) ratio. Microsoft trades at a forward P/E of approximately 30 to 33 times earnings. To put this in perspective, this is a distinct tier above Google, Alphabet, which often trades at a discounted 22 to 25 times earnings due to fears over its search monopoly being disrupted. Microsoft trades roughly in line with Apple, despite Apple having slower growth, because both are viewed as safe havens. It is significantly cheaper, however, than NVIDIA, which can trade upwards of 40 times earnings due to its explosive hardware growth. Price-to-earnings growth, PEG. The PEG ratio sits between 2.0 and 2.4. A PEG of 1.0 is traditionally considered fair value, meaning investors are paying more than double the rate of growth for Microsoft shares. This is a safety tax. Investors are willing to overpay for Microsoft's predictability compared to Amazon, whose PEG ratio can fluctuate wildly due to its lower-margin retail business. Return on equity, RE. Microsoft boasts an exceptional ROE, often exceeding 35 to 40%. This is superior to Google and Amazon, reflecting Microsoft's ability to generate massive profits from shareholder capital without needing heavy physical inventory. Debt to equity, D/E. The company maintains a pristine balance sheet with a D/E ratio of roughly 0.24. This is a fortress compared to legacy industrial companies and even better than Amazon, which carries more debt to fund its logistics network. Dividends. The yield remains modest at around 0.75%, but the growth of that dividend is key. Unlike Google and Amazon, which only recently considered dividends, Microsoft has a long track record of annual increases, making it a dividend achiever that appeals to conservative pension funds, further stabilizing the stock price. Valuation models. Pricing imperfection. When we run the strict valuation numbers, the stock appears mathematically overvalued, relying heavily on future sentiment. Discounted cash flow, DCF. A standard DCF analysis, assuming a 10 to 12% discount rate, the required return, pegs the intrinsic value of Microsoft shares closer to the $360 to $400 range. With the stock trading near $480, it is arguably 20% overvalued. For the current price to make sense, Microsoft needs to grow free cash flow at nearly 20% annually for the next decade, a feat that becomes mathematically harder as the company grows larger. Dividend Discount Model, DDM. Even with aggressive assumptions, projecting that Microsoft raises its dividend by 10% every single year for the next 10 years, the DDM value still lags behind the current share price. This confirms that Wall Street is valuing Microsoft almost entirely on capital appreciation, growth, rather than income. The stock is priced for perfection, meaning any earnings miss could cause a sharp correction. Qualitative factors. The wide moat versus the cloud war. Numbers rarely capture the full picture of Microsoft's dominance. The sticky ecosystem. Microsoft's moat is enterprise lock-in. In a recession, a company might cut its marketing budget, hurting Google and Meta, or delay buying new laptops, hurting Apple. But they cannot turn off their email, Outlook, their cloud servers, Azure, or their security software. This makes Microsoft a defensive growth stock. It grows like a tech stock but acts like a utility during downturns. Azure versus AWS. The cloud war is shifting. Amazon Web Services, AWS, is still the volume leader with roughly 32 to 34% market share, but Microsoft Azure, at roughly 24 to 25%, is consistently growing faster. In 2026, Azure is winning the high-value war, specifically in AI. Because of Microsoft's exclusive partnership with OpenAI, companies building GPT-based apps often default to Azure, giving it a technological edge over Amazon's broader but more generic infrastructure. Management intensity. CEO Satya Nadella is reportedly operating in founder mode, a high-urgency management style typically seen in startups. This is unusual for a massive corporation and is designed to prevent the innovator's dilemma, ensuring Microsoft doesn't become lazy like Intel or IBM did in previous decades. Smaller bets and emerging ventures. Beyond its core business, Microsoft is pivoting its strategy in smaller, high-potential areas. Gaming as a service. The company is moving away from the console wars. Instead of trying to outsell Sony's PlayStation with hardware, Microsoft is pushing Xbox everywhere, a strategy focused on Game Pass subscriptions that allow users to play games on TVs, PCs, and phones via the cloud. Mixed reality. Why? The company has largely abandoned its HoloLens hardware ambitions, ending production of the HoloLens. 2. Instead, it has shifted to a software-first approach, partnering with military contractors like Anduril to deliver the software for the U.S. Army's IVAS headset program. Quantum computing. Microsoft continues to invest in the long-term bet of quantum computing, partnering with companies like IonQ to integrate quantum capabilities directly into the Azure cloud for scientific research. Bull versus bear case. To summarize the investment thesis, here are the two sides of the coin. The bull case. The bull case argues that Microsoft is the utility company of the future. As AI becomes as essential as electricity, Microsoft will capture a tax on every bit of intelligence used by businesses globally. Bulls believe the premium valuation is justified because Microsoft has the safest floor and the highest ceiling in big tech. They see revenue hitting the $500 billion milestone by 2030. The bear case. The bear case warns that the stock is priced for perfection. Trading at over 30 times earnings leaves no room for error. If corporate AI adoption slows down, or if companies begin to question the return on investment (ROI) of these expensive AI tools, the stock could suffer a significant correction. Furthermore, competitors like Google, with their custom TPU chips, may eventually undercut Microsoft on price, eroding margins.